You could have entered two different places here. Above the sweep of the liquidity or upon the order block. And what's price done again? It's done the same thing that I mentioned earlier. It mitigates twice. It's done it here, look. Order block M15, mitigated the order block, come back down, rejected, give us one more sweep of the internal liquidity. So if someone's sold here and then they've set their stop loss to break even, they're taken out. Again here, if someone sells here, stop loss to break even because they see a reaction, they're taken out. This happens over and over again. What's happening, family? It's Ramel again, Roms, your boy Roms, with another trading video. Today's going to be more of an interesting one because I'm going to break down slightly my trading model in more depth. I'm going to show you what I look for, as well as the other things that I teach in my videos. And I'm going to show you something that repeats itself over and over again. So this is video is a bit more of an in-depth one. So stick around for it, get comfortable, because you will learn something. All right. So what I'm going to do is show you GBP USD over the last couple of weeks. And I'm going to show you what I was looking for, and how it's easy for you to make sense of the market when you do this. So if you look at the 4-hour time frame, or we can go to the daily to start off with, but let's start the 4-hour actually. Start the 4-hour. So you can see here, this is GBP USD, right? And let's get straight into it. So first things first, you've got these highs, or the multiple highs here that have been induced to the high side. So you've got these aggressive bullish candles, that took out these multiple highs, and then we've reversed, and price has given us clear bearish momentum. As that's happened though, if you go down if you look at the 4-hour, what you can see here is, so price initially came up there, gave us the strong wicks to show rejection, came back down, took out this structural low, crept up a little bit to create efficiency on the 4-hour time frame here, feeling that this imbalance. Then price dropped again, and then price became bullish again. And as it became bullish again, price mitigated these highs, and it gave efficiency again. But as it's done this, what it's done is taken out this high, as it's mitigated the high, to create another low. So it's creating structure. So it's using structure along with using liquidity. So as it's taken the liquidity, it's respected this high, and then we've created a new low. But what's happened here again? Sorry, I used the wrong one there. It should be POI. So what's happened again is price has done the same thing. Price has trickled lower, and then price created multiple highs, created type of trend line liquidity, came up, took out the internal highs, and then price respected this high and this order block on this time frame. So you can see here, price respected the high again, and then we created another low. So as price has done this, what you can see here is, so we've had the inducement to the high side, but then it's the question is, how do we get in? How do we find smaller time frames? Or how do we find some kind of pattern to get in on? And this is the way that I do it. So what I'm looking for typically, so it's clear, what I'm looking for is this. I'm looking for price to come down a bit, create some kind of liquidity, give me a high to take out the liquidity, break structure in the ideal world, come back up again, create another structure point, and then create a new low. But what am I looking for now? So what I've got on this point usually is, I've got this high as a protected high. So I would use this high as the point that took out the liquidity, and then it's also created a new low by taking out this low, right? So this is now protected high on my side. And what happens here now is, a lot of people may try enter here. They'll enter here, take out, so they'll enter here, put the stop loss above this high, and then it will go create a new low. Then they'll go break even. But what's really happening here is that price is just creating a trap here. So this is just a trap. That's all that's happening. So it's a trap. And what price wants to do, and this is where my entry would come in. So what you'd have here is usually say like maybe a fair value gap or an order block or something along those lines, right? So here you'd have but just basically an entry point that you could enter. The safest place to enter would be just above this trap. So this will be just a high, right? So this is just a liquidity point to enter off of. So you class this as the trap. And this is where my entry would come in. Sorry. So I would enter just above this high. So then I would enter here. Or if there's a better entry, maybe there's a BPR, the start of the BPR, or something along those lines, well, it depends. But as long as it's just above, anything above here, this is the safest entry because it means that you'll definitely be tagged in. I would enter here, and then I would attack the drawn liquidity of the low that I'm going for next. And that will literally be my entry. So what would happen now is, so I'll expect price to then do this, right? So my entry will be up here. My limit would be set. I'll expect price to come back up slowly, maybe even give a reaction here, come back up, tag me in, boom, go. And often what this actually does, this might even create order flow. So this might even create another protected high because that high has now taken out this liquidity, and that high has created a new low. And sometimes what then happens is, sometimes what then happens is price will do this. So price will come back up, create a new high, come down, move up again, and then go lower again, right? And this is, sometimes it might even give you another entry just directly off of here, like that. Or it might, depending on the price action, it might come back up and do the same thing again and just use this area as a trap, tap in, and then go. Sorry, this is incredibly messy, guys, but I'm hoping you get the vibe. I will do another video with a bit more clarity on everything. So just bear with, but I just want to make this a quick one, right? So that's what we're looking for. So let me just remove all of these because cool. So that's what we're kind of looking for. Hopefully that makes a bit more sense. So I'll draw these back on quickly. So you had these highs taken, you had that high respected, and there is more to it than that, of course, but that is something that you can look out for, that to make things a bit more clear. And I'm going to show you some price action now with a few trades that were valid. And this also, it doesn't eradicate timing, but timing matters a lot less when you're looking at price like this, when you've got a clear drawn liquidity. So the drawn liquidity is another key part or key component of viewing price like this, right? So you can see here, that's what price has done. So even if you go there on the lower time frame now, on the 15-minute, what has price done? What I was saying. So you got that it's happened. Look, happens here over and over again. But you got the high here, took out liquidity to the left, created a new low, create liquidity here. So there's a high here, there's a high here, multiple highs, taps in, highs respected, then we go. Same thing again. Comes up, creates equal highs, just along here. But then we create new lows, and then we come back up, and what happens? It takes out these highs, mitigates this order block here, and then goes. And it happens time and time again. And I'm going to show you some price action just around here that's going to make this a lot more interesting and give you a bit more clarity on what I'm talking about. So price has already, excuse me. So price has already given us the inducement high. So we know that price wants to take liquidity on the other side. So if price has taken liquidity on the buy side, we know that price then wants to take liquidity on the sell side, right? So the first low is going to attack is this one here, which it does straight away. You can see here, it respects the structure and then it attacks that low. So this thing where things get a bit more tricky now, in the sense that, are we going to then are we now going to just turn bullish and then just go to take out these highs? Or are we going to creep up? Sorry, take out this high, take out the high to the left and then go back down? Or are we going to do what we actually did? And I'm going to show you what actually took place and how you could have made, you could have got into some of these trades if you looked at the price the way I've looked at it, the way that I've explained, right? So this is taking out this internal low. That's what this is here. So now we look at, where's price going next? Does price want to continue bearish or does it want to reverse? So after a massive major inducement like this, I don't think price is going to then just reverse on us completely. You still got more liquidity to the downside. This doesn't look like any kind of complete reversal pattern just yet. You'd expect some kind of accumulation kind of distribution accumulation schematic to happen where price accumulates, takes a little internal liquidity, then goes, right? But that hasn't happened yet. So going to the 15-minute. So on the first of all, sorry, on the 1 hour or on the 4 hour, you can see this looks like an order block, right? I'm not going to take a trade just based on that. However, if I go down to the lower time frame on the 15 or even on the 1 hour to show you, you can see here that this is the same pattern that I talk about, in the sense that a price has taken out liquidity to the left and then created a new low. Okay, so now that price has taken out this low, we expect price to trade back into the range. The question is, what is the range? Is the range this? Or is the range this? Is it that? This and that? It's a question. And the thing is, both ranges are valid. Or different time frames. Depends on what time frame you're looking at, but both ranges are valid. So for me, because we are bearish, and because I do believe that we want more liquidity to the downside, I would look at this and think, okay, this is my first point of, resistance. When I say resistance, I don't mean support and resistance. I just mean a place where price could reverse. This is our first point of interest. Okay, so if I look at this now, I'm thinking, okay, if prices trades back into the range, perhaps it could respect this high, because it's sweat liquidity. It's created a new low, so there's going to be orders in here. Maybe price is going to respect this high, creep back up, and then go lower. And maybe it's going to give me an entry. Who knows? But let's see how price played out. Cool. So I'm going to go into the 15-minute and play it out a bit, and I'm just going to break down the price action in hindsight, because it's just quicker and easier than doing it candle by candle. I want to make this video. I don't want to make this video too long. All right. So if you first look at this now, you're looking at this and you're thinking, is price just creating trendline liquidity? Is that what it's doing right now? And an argument could be that it is. It is, but is it ready to be taken yet? I'm not sure, because what has price already done? First of all, price has taken out sell side liquidity onto the left, which is this low over here, and now we're trading back into the trading range. So what is price going to want to do first before going bearish again? It's going to want to take out some internal range liquidity. So the liquidity cycle is quite simple in the sense that depending on the if we got clear trading ranges, price is going to take out internal range liquidity and then go for external range liquidity. Then again, it's going to go for internal range liquidity and attack external range liquidity. And often that external range liquidity then becomes internal range liquidity as price continues to go bearish or bullish. Hopefully you understand what I'm saying there. But in this case, what I'm saying here is that price wants to take out liquidity first on the buy side before it wants to go down to the sell side, right? So if I'm looking at this now, I'm thinking, all right, I can see this is a clear high, and this is not going to be I'm not going to take a trade from here. So, I mean, this is not a trading area for me. But I know that price probably wants to go a bit higher than that. So maybe even price might want to even come in here. You can see that you got that little wick there, so it's showing that it's probably a high on a lower time frame. So I'm looking at this now, and even looking at this before you even take a trade, you can say that you can even potentially catch trades on the way up using the same type of pattern. And when I say that, what I mean is, look, prices come down. So first of all, we had price take liquidity here, and then we had a failure swing here. So price responds, comes back down, and then taps into this low, but it doesn't break the low. So that's a failure swing. But in doing that, what does price do? Price also takes liquidity. See these two lows? Which obviously would be a lot clearer on the 5 minute or 1 minute time frame. And then price comes back down, taps in once, and then comes again. So you can see that these multiple lows, 1 wick, 2 wicks, 3 wicks, those wicks, that's like trendline liquidity on the lower time frame. And it's just a low as well. And you can see here, this is consecutive candles, so you can class this maybe as an order block, but it's a low, right? And it mitigates that, and then we break structure. And again, it's the similar pattern. Sweep of liquidity, break of structure. And then what happens again? Price comes back down, sweeps internal liquidity, break structure. And then what happens? Price comes back down again, and look, these lows are being respected each time. So that just mitigates here. Order flow. And then you got here, this low here, this aggressive bearish candle that took liquidity and then aggressively broke structure. Respected. So when you got more experience as well, understanding the markets, understanding the liquidity cycles, understanding what price is doing on each time frame, because now price is bullish on the M1 and potentially the M5 now. You see it's staircasing upwards, right? It's staircasing bullish. But on a higher time frame, we know that we're still bearish. You can look at this price action. We're still bearish. We're not bullish yet. So you can take these trades back into the premium area of this trading range, up into our high that we're looking at. So we're looking at this, and we don't know for sure if this is going to hold, by the way. But we're looking at it thinking it may hold because it's taking liquidity, it's created a new low, and on a higher time frame, we are bearish. So that's what we're looking at. And also the fact that we're staircasing like this shows that potentially this is just, yes, it's giving valid mitigations now. It's valid trade opportunities at this moment in time. However, at the same time, what it's doing is actually creating liquidity to be taken once we've hit our target, our bullish target, which is this high. And even here now, you can see again, these lows that were taken. Within, right? So now look at, so you could have caught some of these trades potentially. And then we're coming back into the premium area of this trading range, so that the M5/M15 trading range, right? So we're going up, we're looking up, prices playing around a little. Now we're going on to the Asian range. At this point, is price looking like it's going to reverse? Not just yet. And this is where it's important, is where you can make your trading a bit more simplified by using structure along with liquidity to make sense of the market. Just using liquidity alone can be done, but it takes a lot of practice and it's not as simple. I find that it's more difficult for me to have a repetitive, say, entry model or repetitive trading system without using structure. So I use structure as well as liquidity to validate my entries. Because even in here, guys, prices that create lows of equal lows here. Then what does it do? During Asia, whoops, inducement to the low, break of structure. And then what does it do? Respects this low. So it's just showing you just the way the market just repeats itself. It's the same thing again and again, like liquidity taken, break of structure. 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 So once you know where price is heading and where price is going, that's all you actually have to look for. So not every trading environment is perfect for this type of trading, but there are a lot of days where the trading environment is perfect for it. So let's keep looking. Right, cool. So this is where now we're in the premium trading range, and we've tapped into say the high of this trading range, and then we've broken structure as well. So if I go on to on the 5 minute, you can see a bit more clearly. Let's zoom in a bit. Great. So as you can see, we've taken out this high. Okay, taking out these highs obviously already as well. Taking out this high here, and we've actually mitigated this little. There's probably an order block in there or something in there, right? So we've mitigated that, and then price has now given us a reversal pattern. What is the reversal pattern? In the sense that it's taken liquidity, swept liquidity, and then we've broken a key area of structure. And I'll say that this is a key area of structure. Why is it a key area of structure? Because this here could be classed as just liquidity, trendline liquidity. So if price was to come down here, price could just come down here, and then it could just mitigate here, and then go higher. Because this here is what we've been looking at, right? Swept liquidity, and it broke structure. Swept liquidity, broke structure, right? So that is, a key area here, because I wouldn't want to take a trade up here, but then the price could just reverse here and take me out. So here, once this happens, this is a nice key area of structure that's been broken. And now we're looking at a potential reversal to attack the bearish side again. And where are we trying to attack? This is a good question. First things first, this is a clear, consistent mitigations, clear trendline liquidity for me. So this would be my actual target in a bearish sense. If I was to get a good entry, I'd want to hold at least a significant portion of my entry to this target, this low, because this is clear liquidity. We've taken liquidity to the sell side, which is the low to the left. We've taken liquidity to the buy side now, which is these highs here, which is pretty significant. And also, you know, this high here and these highs here. We've created more liquidity here, and it's given us, you know, the fake, maybe you can cast this as a fake break of structure here. And then we've gone higher again, giving us a fake break of structure here. When you see it's actually just a sweep because of the wick, it's a sweep. Fake break of structure, it's gone higher again, and now we've given us the full body break of the low, and it's looking like, you know, we'll want to go bearish. So this is now my draw on liquidity. So this is where having a draw on liquidity makes trading a lot more simple, because you know where price should be going, you know, based on your analysis. You're not always going to be right, but you know, it makes trading a lot easier. So if we're looking at this now, where would I want my entry to be? And you could say, you know, what we looked at here, liquidity taken to the left, internal liquidity has taken here. Then we've had the break of structure. Where would you want to go? So first of all, you've got a nice fair value gap here, or imbalance there. You've got a nice imbalance here. However, this actually is efficient price action on the high time frame. So we're going to the 30-minute time frame. You can see here, look. So although that there's a fair value gap there on the lower time frame, you can see here on the 30-minute, this is actually efficient. You see this wick has touched this wick, right? So that's efficient price action. So really and truly, it's looking like this would be the nice liquidity that price could want to take to go higher. And you got a nice, you know, order block here on the 15-minute. On the 30-minute, it actually comes up as a hidden base. But if you go out to the 15-minute now, see, it's a nice order block. See, me personally, I'm still developing, well, I couldn't say the guts, but I'm not sure if I would take the trade based on just this and my stop loss here on this order block. It's very valid. Would I do it right now? Or maybe even on the order block, depending on what you want to do. But would I do it now? I don't know. If I'm honest, I don't know. I like always putting my stop loss above the highs, personally, but that's too much of a crazy stop loss to do it here. So this would be the better stop loss placement. And, you know, you can enter either on the POI, which would be the order block in this case, or you could enter on the sweep of the liquidity. The sweep of the liquidity is the more, you know, I want to say accurate, but it's the more common entry, because you know that you're always going to be tagged in. Whereas this might just take these highs, not tap the order block, and then just reverse. So depending on how you want to do it, it's completely up to you. So that's what we could do. But if I go on to the 5-minute, we can see how price plays out a bit more. And then I'm going to quickly mark this up. Bearish order block M15. Quickly mark this up, and we can see what we're looking at. See how price plays out. So price plays around. You can see here, got this choppiness, and what price is actually doing is just, you know, creating more liquidity. But price will come back up. There we go. Cool. Sorry, that was a lot of price action to go through. Apologies. So I just skipped. So price has come in, tapped in this order block. But let's go through this first. What is price doing here in this constantly ranging or consolidating, as people would call it? What price is actually doing? There are actually trade opportunities in here on a lower time frame, but you know, we know what we were looking for, and this is also a good way to be able to trade if, let's say, you've got a busy schedule, or you don't want to try and trade on the 1 minute or the 5 minute. You want to just take high probability trades because you wanted to spend less time on charts. So what price has actually done there is engineered liquidity in order to go back up to take out price. But before it's done that, what it's also done is induce people to the low side and to the buy side. So we're coming down here and we're creating all these lows. Look, you can see here, creating these highs, liquidity being created here. Induces everyone to the low. Boom. Takes everyone out. Back up. Takes out this high. Reverses straight away. Boom. Taking out all of this liquidity. And then come back up. There's no liquidity here, so it's just giving us efficiency and filling the imbalance. And then we go an aggressive move to the downside. So at this point, often a lot of us will probably be thinking that the moves happen now because we've got, price has shown intent to go bearish. But what it's actually doing is just inducing to the low, taking out these multiple lows. Now everyone's getting in. All the breakout traders, all the support and resistance traders, maybe support at this level has been broken, or all these different traders have been trying to get in now, and they're about to get smoked because the price is going to come back up, and you've got some smart money traders trying to get in there. But where we look at this now, we know we're looking at it as as price. So from the premium range and for the premium point of the range to the discount point of the range. So you've got two parts of the range. You've got this part of the range, which is the high. And you guys, I'm sure you guys know this already, but you've got premium and you've got discount. So we're looking at it from this part of the range. But we know we want to look at the premium part of the range, and we want to know that we know what we're looking for. We've had the sweep of the liquidity to the left. We've had the break of the key level of structure, right? And then we've got the liquidity point that we're looking for to be swept before we get into a trade. So while all this is happening, this is a whole day's worth of price action, right? So if you're not trading on the 1 minute or the 5 minute, you're not interested in this on this day. You're not interested in getting in a trade here. However, there are valid trades there, but you're not interested because you're looking at it on a higher time frame. And then on that, finally, price induces to the downside and then give us a nice move straight back up, bearish, right? And mitigates our order block that we're looking at. Mitigates it once, rejects, responds, and then it comes again. Price does this a lot. It likes to give two reactions. I don't know why it does it. It's annoying, but price is price. And then it gives us a nice break of structure here. Let's just play on for a second. So, what's price done again? Let's have a look at this for a second. And this is where you got to start training your eyes. So this is the first trade opportunity would have been if you had the guts. This one here, stop loss above the order block or above the high. Let's just go above the order block for now because the order block trade is valid. This is just for backtesting purposes, all right? So don't be at me in the comments saying, oh, you didn't take that trade. I know I didn't. I'm just doing it for education purposes for yourself and myself, right? So we're looking at this now, and what do we look for again? We know that our drawn liquidity is bearish, so we know we want to go bearish. We know that we've hit our point now of liquidity that we want to be taken on the buy side, which was this high here. Our potential POI, our order block, has been mitigated. We've had now the pattern to show that it's taken internal liquidity and it's given us a nice break of structure as well. And then prices come up. And what is it done again? Look, let me show you. We've got these highs, 1, 2, all these highs, right? So you've got all of that. And you've got this as well. And then you've got this low, which has now been broken. So this is the pattern I'm talking about. Sweep of liquidity, break of structure. Within the narrative and within the bias that we have. So there's more, it's not just looking for this pattern, there's more to it. And I've broken this down for you guys. So now I'm looking at this, I'm like, okay, so if we wanted to enter this, guys, where could we enter? And there's two things here. Two places. We've got the high here. This will be a high on the lower time frame. It's gone in 1 minute. See? On the 1 minute, this is a high. This is a liquidity point that I would like to be taken. On the 5 minute, you can see it's looking like an order block, right? It's looking like a candle that is, looking like a candle that could be classed as an order block. However, there's no imbalance after it. But so you got this here, so you could just enter here. If we're following the rules of the model, you could just enter here and target this low as the safe target first. 6R trade. Or what else do we have? This is a beautiful order block here. Stop loss above the high. Beautiful order block. Maybe that is where you want to enter. So for bearish order block, M5. Maybe it's there. So this is the two places you could enter. It's completely up to you where you would want to enter. And then, so let's say above the liquidity, so on the liquidity sweep or upon the inducement of the high, the M1 high, or there. But you see here, 16R, 6R. Big difference. However, you decide how you want to play it. So let's first play it. Let's see what happens. Okay, all gives us a nice. Okay, but now we're going through Asia. This is now playing around in Asia. Asia creating liquidity as it always does. And then now we're in London. And cool. Now we're getting interested. So let's move the stuff over. So we've got, wow, what happened there? Order block. Liquidity. Those are the 2 points we're interested in. We're not interested in anything else. And that's what makes it a bit more mechanical. It makes it a little bit more easier, the rules easier to follow, because you're not trying to look at 5-6 different places where you could enter. So you've got the order block and you've got the liquidity point at the M1 high. So as you can see here, price is tapped in once. It's tapped in again. Is it going to break? Is it going to take the high? Or is it going to just reverse from here? Look at that. And that's beautiful as well. And before we even show anything else, let me show you something else. So you could have entered 2 different places here. Above the sweep of the liquidity or upon the order block. And what's price done again? It's done the same thing that I mentioned earlier. It mitigates twice. You've done it here, look. Order block M15, mitigate the order block, come back down, rejected, give us one more sweep of the internal liquidity. So if someone's sold here and then they've set their stop loss to break even, they're taken out. Again here, if someone sells here, stop loss to break even because they see a reaction, they're taken out. This happens over and over again. So this sweep of liquidity, and we have break of structure. Yeah, break of structure. And then what do we have here? It's even better. A nice liquidity point again. What did I mention earlier about the trading model? What I like to see, remember what I said? I like the sweep of liquidity, break of structure, and then I want it to come back up once and then come back to create a liquidity point here. See it? See it? It's the same thing again. I'm telling you now that this model makes things 10 times easier, and your entry then again will be just above the liquidity as I mentioned. But like this. Or on order block like it was here and like it was there. But again, here for example for me now, entering here would be above this high as another entry. Mainly because there's no clear POI within this imbalance or say fair value gap or BPR. So maybe even the start of the BPR, depending on how extra you want to be, right? So let's see what happens anyway. Cool. So it actually does tag me in. It would have tagged me in at the start of the BPR. So that's a nice entry actually. Yeah. This high literally only just about respects this high. I actually looked at it before, and yeah, let's have a look now. The high, the coordinates are 26452. This high coordinates is 26452. So yeah, this is why it's important to make sure you add the extra spread onto your entry to make sure you don't get tagged out by spread. And this is also why having a raw spread account is also better as well. But yeah, so that's the first entry here on the order block. And the second entry, like I said, that you could potentially sometimes catch is the continuation entry as price induces the high. So it's above this high. And let's see what happens. And then you target this low initially, or this low, or if you're feeling really brave, then the actual draw on liquidity, the main draw. Let's go back to the 5 minutes to see how this all plays out. A nice regressive response. Back in again. Oof. So this is where, it's just Asia, that's why, that makes sense. This is often another reason why I don't like trading in Asia sometimes. So let's look at this for a second. So price gives us the entry. This is the start of Asia. So if I'm being real honest, guys, it's not an entry I would take. I don't take entry during that time, but it's still valid. It does sweep the high, induces the high, gives us the entry into our entry zone. And this actually does the same thing. Takes liquidity on the way up, internal liquidity on the way up, internal liquidity on the left, gives us a nice break of structure, comes back up, and does the same thing. Let's see if I can go on the 1 minute, see if there's actually a fair value gap there. There is. And this high, 6422. 6422. So this high was also respected. So again, this gets crazy. So you had this entry, and then the price does the same thing again. Look at this. Sweep of liquidity. Sweep liquidity to the left. Break of structure. But what it's done before it's broken structure is it's created a liquidity point to take for the continuation here. Or even there's one in there as well. You can just see it. This. Let me do that for a sec. This high on the second time frame, that would be a high to take as well. So again, you got another entry potentially on. This is the final M1 candle. I'm not gonna take an entry there. I'm gonna be honest with you. I'm gonna end. If I'm entering on this, I'm probably entering above this high here, or to be safe, just here. And then even within this, you've got entry opportunities. So on the M1, look, it's respected the high, so you know that you should be going the right way if it does this. So sweep of liquidity, break of structure, so you can this low or this low, break of structure. And then it's not ideal in this one because there's no liquidity to take into it much. There's only a little bit here, but you've got another entry point, say within this premium area of the range there. It's just the same thing over and over again. But let's put that as an entry here. Again, the stop loss would have to be a good size so that spread doesn't take you out. Okay. So let's look at some more. So I've got one more trade to break down. This is a lot. This is a longer video, so hopefully you're enjoying it. Remember, if you're still watching it and you're still enjoying this, hit like, hit subscribe, and you know, yeah, enjoy it. Just enjoy it. So look at this price action again further. So now you can see here, upon this all happening, we're creating like a build up of liquidity just here. It's a nice build up here. We've got, you know, highs being respected. You've got liquidity being taken. You've got lows being broken. So ideally here, you'd want, if this give us the entry. So I think on other brokers, this entry was actually valid. I've seen the wick taps into this point, and this would not be a nice entry here. It doesn't actually give us the entry here, but this is another nice potential trade opportunity. Looking at this. And then, let's fast forward. And this is for me, the importance or the ability to be able to really just, use what you've learned and then take it and you build a simple system around it. And by building this model, I say build it. Well, I've learned it from different places, and I've sat on it. So by building this, I've got a simple, clear way of looking at the market and how I want to enter. Do you know what I mean? And I wanted to share that with you guys today. So again, what is this? So this now here is, we've got price rejecting lower. So we know that price is going towards our drawing liquidity and price is starting to run away. We can't expect price to come all the way back up here necessarily. It might not do that. You see what price does here is, let's go to the 1 minute. It creates efficiency on a higher time frame. That's what this mitigation is, or this low. It creates efficiency. Some might call it a breaker. And as it's doing that, it's taking liquidity on the left. It's taking internal liquidity here with this high. It's giving us a break of structure, and I'll just use this low even, and it's even better here. Break of structure, creating a nice new trading range. And then what you've got again is what? Where would you want to see the entry? You can see here, you've got liquidity here to take into the premium area of the range, or the last, say, 25% of the range. Nice fair value gap. And to be safe, you want to stop loss maybe above this high. And then price taps in. and goes again. And now price moves towards our draw on liquidity. So as you can see here, there are multiple trade opportunities. When you've got a clear draw on liquidity, when you've had a clear inducement, to one side you've got structure supporting your bias, and we knew that we were bearish on the higher time frame. This is how you can enter trade after trade after trade using a simple model. Hopefully you guys enjoyed it. Don't forget to hit a comment if you enjoyed this. Just leave a comment just saying you made it to the end, and then I'll respond to you guys, and hopefully you guys got something from this. And if you want to watch another video, click the video in the corner and you can learn some more from me. God bless, take care, and I'll speak to you soon.